Which states offer 16% tax liens? Welcome back. In this episode, I'm going to answer your question, which states offer 16% tax liens? So stay with me on this because you'll see that it really is many states will offer 16% and a heck of a lot more. Now, my name is Ted Thomas. For the past 30 years, I've been involved with tax liens and also tax deeds. And today we're going to specialize in tax liens and show people how they can earn 16% interest on their money and a heck of a lot more. So this is a business that is abundant. It's everywhere. Half of the states and counties will sell tax lien certificates. The other half of the states will sell tax deeds, which come from defaulted auctions. I'll tell you about both of those, but we're going to concentrate on tax lien certificates today. So this is a business of abundance. You can get involved and earn 16%, 18%, up to 36% on your money with a tax lien certificate. All right, before I finish this video today, I'll talk to you about two big mistakes. Now, those two big mistakes have to do with what takes place at auctions. And people make a lot of mistakes at the auction. I'll show you how to avoid those. So stay with me. I'll be right back. While the correct answer isn't just one state, people like to say, well, Arizona has 16% tax liens. Well, I'm here to tell you other states have higher rates, which is good. And sometimes when people are bidding the rate down, you could still get it at 16. So many of the states will pay 16% and more. For example, Florida has 18% as their highest rate, but some people will bid down because there's competitive bidding at the auction. If they bid down, it might be bid down to 18%. It might go down to 14%. It might go all the way down to 0.25%. Now, I don't know why anybody would go down to 0.25%. I always tell my clients, don't go below 5 or 8%. You want to make money on your tax lien certificates. So the point is, there's many different states and many different ways of doing this. Why is that? It's because the states became states at different times. In other words, we started out with some colonies, then they slowly developed the Middle West, and then finally just California came on board, and Washington State, and then finally the last one was Oklahoma. So sure enough, these states have made their rules at different times, and that's why not only the rules are different, the laws are different, and the rates of return are considerably different. Everything that I'm going to talk about on these videos and throughout this channel is 200 years old. This is an old system that was developed because many people didn't pay their tax. So the state legislature got together with the county and said, we need a system. So the system simply is tax lien certificates and tax deeds, and that's what you're learning about today. So what happens? Lots of people don't pay their taxes on time. And I'm talking about property tax, not an excise tax, not an income tax, nothing to do with the IRS. This is simply a property tax, which every property owner is mandated to make. So the only people that don't pay taxes are the schools and the churches. Everybody else must pay property tax. So the government gives you a right to own property, but you can only own the property as long as you pay the tax. So if you do own it and you pay your tax, you can subdivide it, you can rent it, you can farm it, you can do anything you want with it, but you must pay the tax. So why do you have to pay this tax? Property tax, I should say, is what makes the government work. The government has a lot of bills to pay. So local government fixes the roads, takes care of the court system, pays the school teachers, pays the police department, pays the fire department. You're getting the idea. All those are bills, including the county employees. They all have to be paid. So if people don't pay their property tax, well, there's a big problem at the county because where are they going to get money to keep this government going? So what they do is they simply sell a tax lien certificate in half of the counties. Now, keep in mind, there's 3,000 counties across a little more than 3,000 across the United States. Half of those counties will sell a tax lien certificate. The other half of the counties, what they will do is they don't sell a certificate, they give notice and they confiscate the property. Well, right now, we're just talking about tax lien certificates. But on this channel, you can find other things about tax deeds. But today, I'm going to concentrate on tax lien certificates. So, what's going on here? Well, the property owner hasn't paid the tax. They've been notified that if they don't pay the tax, there will be a consequence. The consequence is that they will sell a tax lien on the property. Now, that's a lien on the property. That's a levy on the property. And so that simply means anybody that wants to come in, once it's advertised, and pay the tax and give the government money to pay for the certificate will now have rights in the property. So basically, in one sense, you're loaning money to the government, but your security for that loan is the property. The property is your security. So this is a safe, secure investment. Now, what happens? Well, most people will come in and pay. According to the counties, 95, 97% of the people come in and pay their tax. So that means you get paid whatever you invested plus whatever high rate you purchased. So if you bought them in Illinois, you might get your money back plus 36%. You bought them in Florida, you might get your money back plus 18%. So the state decides on the rate. All right, but you're going to get your money back plus that high rate of return. Is that a good deal? It's not a good deal. It's a great deal because the interest rates are absolutely outrageous. But you're saying to yourself, wait a minute, Ted, why do I want to invest in one of these people that's not paying their tax in the first place? Well, first of all, they're not bad people. They might have had sickness. They might have had a car wreck. They might have had some crises with their kids, and they're in the hospital. Who knows? They didn't pay their tax. So they're staying in the property anyway. You can't kick them out. You don't get possession. You get the certificate. Why do you want to buy it? Because if they don't pay you, you will end up with the property. Now, what did you pay for a property? Property taxes are 1 or 2%. So 2% of a $100,000 property, what is that? It's a couple of $1,000. Would you like to end up with a house for a couple of $1,000? Well, now let me add the kicker in on. These properties are sold with no mortgage. Now, let me say that again. The property has no mortgage. Why? Because the county wipes out the mortgage. Now, how can they do that? It's an act of law. It's the law in every state that when an auction takes place, it wipes out the mortgage. Now, did I say that they're tearing the mortgage up and destroying it? No. The bank still has the mortgage with the person that signed it. When the person signed it, they signed a promissory note. The bank no longer has security of the property, but they still have that person's signature, and they still have, so they can still go after those people. So can anybody do this? Yes. You can buy them for $50. You can buy them for $500. You can buy them for $50,000. Any amount that you want. So if you're a big-time investor, perfect business for you. It's safe and secure. You can't give money to Ted Thomas. You're going to give it directly to the county. The county's going to issue you a certificate which you can hold. If you don't get paid on that certificate, you will ultimately get the property. So these are powerful certificates. Now, can you make a lot of money on tax certificates? Here's something to think about. Let's say you bought a certificate and it was a 16% certificate. Wow. Well, you've got a nice rate of return. So let's say a whole year goes by and they don't pay you. Well, at the end of the year, they would certainly owe you the principal and now some interest. What if you combined those two and reinvested again? And then they took the combination of that and reinvested again. In other words, keep taking whatever you're bringing in and keep reinvesting it. Well, if you started out with $2,000 and you did what I just mentioned, you'd find at the end of 20 years, you had $30,000 and you only invested $2,000. That's the power of interest and reinvesting what you made each time and doing it over a period of time. All right, so now tax lien rates can be pretty high. The lowest I've ever seen was 8% in Oklahoma years ago. Recently, the lowest is 12%. The highest recently is 36% in Illinois. However, back in the days when I had black hair and I was skinny, well, in those days, we could get 50% in Michigan. All right, so let's just do a little quick review. You decide to buy a certificate in the state of Iowa. Iowa pays 24%. All right, so you invest $2,000. $2,000 at 24%, you're going to start getting some real money at the end of every year. So if you take that principal and the interest you earned and you invest it in the subsequent year and you keep rolling it over, at the end of 20 years, your $2,000 investment is now going to be $120,000. Now, it's fourth grade math. You can do it on your cell phone if you want to, but the point is it's a business that has power and you can make a lot of money with your money. So I'm going to finish this by answering two questions. What happens if the property owner doesn't pay the subsequent year tax? Well, anybody can pay the subsequent year. So when you go in to pay the tax the first time, the clerk will ask you, do you want to pay next year's? And you always want to say yes. Why? Because now you own both years' taxes. If you don't want to buy both years, you don't have to. You can buy that year, but then I can come buy the second year. All right, you'll still have the priority lien because you were first. Okay, the point is buy both of them because you're going to get that high rate of return. So let's say you bought a $2,000 certificate. So buy it on this year and buy it on next year. When they come in to pay, no matter when they come in to pay, they're going to have to pay the rate of interest on the amount of money that you invested. So if you invested $2,000 and they paid you at the end of the year, you'd get paid on $2,000. But if you invested $4,000 both years, they're going to have to pay you that 16 or 18% on the 4,000. So invest as much as you can possibly afford. I talked earlier about two mistakes that investors make. Not only newcomers make them, but experienced investors do the same thing. So I'd like to see you be able to avoid these two mistakes. And what are they? They're at the auction. And what people do at the auction is they get all excited, they start bidding, but they haven't looked at the property. If you haven't looked at the property, you could end up with a chicken farm. I don't think you'd want that property. You can end up with a property that's been damaged in a hurricane. What if there was a fire? The point is, don't buy what you haven't seen. I always say to my female investors, look, you wouldn't marry the guy if you hadn't seen him. Certainly don't buy a property if you hadn't seen it. So that's it, mistake number one. Mistake number two is almost the same thing. People get to the auction, they got lots of excitement, they're determined that they're going to make money, and so they start bidding. Well, you don't want to just look at a number on a list and start bidding. You want to have looked at the property, like I just mentioned, but you also want to have planned what are you going to do with that property. So I call that the exit strategy. What is your exit strategy? You don't want to just start bidding to win the auction and bid high. If you do that, where are you going to end up? Well, you'll end up owning something at a high price. Well, you can't sell at high prices. That's not going to work. Those two mistakes at auctions you want to try to avoid. Now, I have a gift for you. It's right below me. It's absolutely free. You can just sign up and register, and you'll receive that gift. And what will happen is you'll get information on how to make money with tax lien certificates and tax defaulted property. So just sign up below.